The gentleman from Colorado, Mr. Tipton, is recognized for 5 minutes.
Thank you. Chairman Powell, good to see you again. The U.S. Chamber of Commerce released a report this last fall that found that bank lending to small businesses has not kept up with the needs of the economy, suggesting that small business loans remain down 13% from 2008. The report goes on to point out that several regulatory actions have contributed to the slow growth in the small business loans, and particularly pinpoints that U.S. regulators have imposed substantially more stringent standards on our largest institutions than what's required under the Basel III international standards. As a former small business owner out of Colorado, I can testify that the ability of a small business to be able to access capital is vital not only in my district but nationwide. As you've acknowledged, the banking system today is well capitalized, highly liquid, and there have been significant improvements to the risk management and resolvability. Given that, wouldn't it be appropriate to recalibrate some of the international standards that have been gold-plated in the U.S. so that the excess capital tied up by those regulations can be deployed back into the economy to support small businesses and our consumers?
As I mentioned, I think that the capital levels we have in our banks are about right, and I'm open to evidence that that's not the case. But I do see our banks competing successfully and being profitable, and also being resilient to the eventual downturns that will inevitably come. So I think I'd like to see more evidence before we start lowering capital standards. I think we ought to hold them where they are for now.
Okay. I appreciate your comments on that. It's kind of my understanding that we've not only met but exceeded under federal regulations the Basel standards. Our European counterparts have not done the same. And the goal is to be able to make sure that we're keeping the robust economy and job growth going, and opportunity and hope is something that you'll continue to keep in mind. Mr. Chairman, we've talked a lot today about some of the CECL requirements that are going to be coming into place with the accounting method, and do want to be able to express that I've heard concerns that implementation will be expensive and that inevitable mistakes are going to be made after the implementation that will also be expensive. I've also heard concerns about how CECL standards will interact with the ongoing stress testing. Mr. Chairman, with the implementation of CECL on the horizon, is the Fed preparing to incorporate CECL into its supervisory stress tests before it applies it to all banks in 2022?
I think the answer is we're not incorporating CECL, at least for the next couple of cycles in the stress tests. The stress tests are already forward-looking. Of course, they have forward-looking losses that are assumed to happen. So eventually we will incorporate it, but not for the time being.
Do you feel that the regulators are well positioned, given some of the implementations and inevitably some of the challenges that are going to come out of that implementation, to be able to respond in a timely manner?
To respond to?
Some of the challenge that is going to be faced by the costs and the implementation of CECL. Are they going to be able to respond?
Sorry. Yes, I do. I think we're alert to what we're hearing, and we've given our institutions a 3-year phase-in period, so they can, and they've also had some years to study and understand it, and we've worked with smaller institutions, so they know they don't have to have a department of CECL implementation. Try to get that done in an efficient way.
Great. Well, I appreciate that, and I know that you're going to be keeping an eye on it, and would like to encourage you, just for the impacts potentially on the industry and on our economy, just to monitor the subject. Mr. Chairman, in your testimony, you did also note something that's important for my part of the world. There's a noticeably lower employment rate in terms of the communities in rural areas compared to the urban areas, and that gap has widened over the past decade. Has the post-crisis regulatory environment for community financial institutions impacted job creations in rural communities?
I don't think that's really the story. It seems to be more loss of manufacturing jobs. If you read the box, there really isn't. I wish there were a clear answer at the end of the box. You get there and it says, okay, here's why and here's what we can do about it. It's not that simple. So essentially the unemployment rates in rural communities and metropolitan areas haven't diverged that much. What's diverged is labor force participation. And it seems to be, it possibly could be tied to lower education levels in rural areas, but that doesn't seem to explain much of the difference. It may be that it's more about loss of manufacturing, which is more likely to take place away from metropolitan areas. We're still looking at why, but it's, you know, it's a significant disparity that emerged really after the crisis. And if you go back a ways, rural areas had higher participation and lower unemployment. So it's a curious development and one that we're calling to your attention and trying to understand.
But yield back.
Gentlewoman from California.